Rainer Ender, Global Head of Private Equity with Shroders Capital. Welcome to the studio.
Welcome, Magnus. Thank you for hosting me.
Mm-hmm. Today we're going to talk about your area, the private equity space, and learn a little bit more, hopefully. So, first of all, what is private equity?
Private equity is equity investments into companies that are not listed. So it's basically the big universe of companies that can be financed by institutional investors, which are the private equity investors, and mostly with control investments that make them majority owners and therefore in very close control of the business plans.
Mm. And if you compare the private market to the listed market, how big are they and how do they differ when it comes to branches, the industrial parts, etc.?
Yeah, the private equity market has started very small and is basically 40 or 50 years old. If you look at the first initiatives, I've been in the business since 2001 in this specific business at Shroders Capital, it's private equity business, and it's grown significantly since. It's grown because it's delivered. So the clients who started investing, they've achieved outperformance from private equity over public equity and therefore increased their allocation to private equity over time. Today, private equity gets about 700 billion of fundraising per year, which means the market is about 4 trillion private equity market. That's 3% of the public equity market, roughly.
Mm. And the different, at what stage do one invest in private equity? I mean, from the company perspective, is it the growth stage, the early stage, or late stage, or is it smaller or bigger companies, or what's your reasoning?
The private equity market can be segmented into different segments. Venture capital, startup financing is one part. That's a smaller part. Then there's growth equity markets. That's when businesses are growing and need capital injections for further growth. And then the biggest part is the so-called buyout market, which is control investments in more developed, profitable businesses. It's always typically smaller than the public equity market, but the largest buyout transactions are very meaningful multi-billion businesses and they get the biggest attention from the media, and also the largest mega fund managers get the biggest attention from the media, but they are just the biggest part of the private equity market or the buyout market. We focus on smaller businesses. So we invest mainly with businesses that are in revenue and therefore also enterprise value around 500 million or smaller. And that's the complementarity of private equity to public, that you can invest in smaller, more agile businesses that have innovative leadership and growth trajectories independent of the macroeconomic trends.
Mm. And in the private equity funds, how many holdings is typical to have?
Well, here we have to differentiate between different types of funds. Here we're speaking of the semi-liquid funds that are accessible for retail investors, like the one we have on your platform. But basically there we are already in a portfolio with about 100 portfolio companies in one fund, so well diversified and balanced as a portfolio.
And with regards to the different geographies, are you also having a diversification across the globe?
Yes, the private equity market is global by nature. It has a home bias to the US weight as the public market has. Our strategy is more equally weighted between the US and Europe, with a small allocation to Asia on an opportunistic basis.
Mm. And how would you say that Shroders Capital differ from the largest players like Blackstone and KKR in this market?
Yeah. We're also a very sizable player. Shroders Capital has $100 billion under management. In the private equity space, we differentiate by diving deeper, looking for smaller companies to invest in and create more growth with these businesses. So we dive deeper, do more work to invest less money. And we do that because we can tap into more attractive investment opportunities. Mm. We buy these smaller businesses well, transform and grow them, for example, with add-on acquisitions, and then sell them upwards to larger buyers. And that creates a higher potential for strong performance and an an alpha within the private equity market.
How common is it that, let's say, when a private equity company does an exit of a portfolio company, that it goes to the public market versus another private market buyer?
That's a very good question. It's different, obviously, per segment, but I give you an example of the US market. In the US, you have 4,000 listed companies left. It's shrunk from 8,000 to 4,000. On the other hand, the pure buyout market, so these control investments, the pure buyout private equity market in the US owns 12,000 companies today. So it's obvious that IPO cannot be the exit route, number one, right? So IPOs only play a role for the largest private equity owned businesses and for the venture space, obviously. But for the smaller buyout market, it's selling to strategic buyers, so larger corporates, or selling to larger funds who then want to grow the business further. That's the main activity.
So from your perspective, it seems that, let's say, the exit is more driven by the fact that your portfolio holding has basically come to a different stage, in a growth stage or size, that it doesn't really fit into your investment philosophy anymore, right? So another buyer going into a larger part of or larger segment, or let's say the companies are larger, then they take over, or why would they otherwise, be interested to buy the company that you would sell?
Conceptually, that's as you say, but the other important thing for private equity is that private equity is an investment model that is based on a kind of 5-year holding horizon and a plan to transform a business within 5 years or over 5 years, and then to have it positioned as an attractive acquisition for whoever. And so the 5-year business plan with a clear growth trajectory and investments up front to really have something different in 5 years is the base philosophy that holds across private equity. And that differs from the public market, where the quarterly results are driving management decisions. So a 5-year plan, as set by the control investor that owns more than 50% of the business, and aligned with the management that is in the business, to not earn a bonus next year, but to earn a significant gain when the business is sold in 5 years, aligns everybody in private equity for the best possible outcome in the long run.
And you mentioned earlier that the private equity markets basically has outperformed the listed market for a very long time, right? It doesn't really make a difference whether you look at a 5-year window or a 15-year window or a 25-year window.
Yes.
So how is this possible?
So it's possible, in our view, from an empiric evidence, first because it's a control investor. So it's one shareholder that drives the strategy together with management. It's not a broad-based shareholder base as in public. There's a better influence on that and a better alignment on that. There's the 5-year horizon that is pursued and not the short-term noise. So that gives you more long-term vision and also more willingness to invest upfront against immediate EBITDA growth. And it's also driven by a different mix of industry sector exposure. The public market today is the blend of the history, right? It's the stock market is all listed companies as they happen to be today. The private equity market is always oriented towards more forward-oriented business models, and we have an overweight, for example, in asset-light businesses and in service-oriented businesses. For us specifically, this is 5 industry sectors. It's healthcare, technology, business services, a bit of consumer, and a bit of industrial. But it's a different mix that has outperformed also because we're always adjusting the sector mix, obviously, into what will change in the world over the next 5 to 10 years.
Let's say I'm a retail investor and typically invest in a broad stock market index fund, right?
Yep.
So what would be different if I would invest in one of your private equity funds? What is the different exposure I would basically get?
So you will get much more smaller hidden champion portfolio companies, specialists in their field that have a nice growth story, that goes unnoticed in the market. It's not dependent on economic growth, right? In Europe, we've generated great performance despite all the economic low growth. And its individual business is well diversified across these industries and sub-industries that are on a strong growth journey because the sub-industry is under change, right? If you imagine on a 10-year horizon, 10 years ago there was no cloud services. Now there's cloud services. Software applications have gone into software as a service business, right? Outsourcing has become a trend, and we love outsourcing business models from the outsourcing service provider because the switching costs of outsourced services are very high, so it's very sticky business. So long-term recurring revenue businesses have grown, and that's the markets that we focus on. So CDMOs, that's the outsourcing contract development manufacturing organizations, just as an example, is the outsourcing of the pharma industry of their production or even drug development work to be more efficient. That's something that we've done a lot, right? And that's a trend. And these are things that you can buy in a very pure play, specialized business that grows within private equity that doesn't exist in the public market.
Mm. And keeping the focus on the outperformance, how large has the outperformance been for private asset versus publicly listed companies? Or if you compare a private equity space on a meta perspective compared to global equity indices like MSCI World Index.
The MSCI World performance has typically been outperformed by about 4 to 5% in the 5, 10, 15 years horizons and longer. And that's basically the growth story behind private equity is
per year.
Yes, annual performance, outperformance. And that's basically the story, right? Pension funds and institutional investors started investing into private equity when it was a cottage industry 20 years ago, and since then have increased and ever increased their allocation to private equity because they got what they expected. And that's what we call the illiquidity premium, right? And so if you buy an asset that is less liquid, you want to earn more, else why would you accept the illiquidity? But the industry has grown with fund structures that were called, or that are called, closed-ended funds. They have a fundraising, and then they have a 10-year term where the money is called from you, and you have to honor capital calls. And then when a business is sold, you get distributions. It's a relatively complex operational element to that. And in the last few years, the semi-liquid fund structures have emerged and grown, and they make private equity more accessible. And there's basically three main differences to the old traditional way of doing private equity. You don't need an as big investment amount as in the past. In the past, you had to have $1 million to commit to a fund. Now we are moving into the retail market with the new products. The second thing was this operational administrative burden, that you had a commitment with calls and distributions, so wiring money back and forth. And that's overcome with these semi-liquid funds that feel like a mutual fund. They are not, obviously. And the third thing was it was completely liquid, which means you had to make a commitment, you had to honor the calls, and you had to wait, and you would get money back whenever, but over the 10, 12 years horizon. On the semi-liquid fund sizes, the funds that we have today in the regulatory frameworks, the liquidity is provided under normal circumstances. In difficult times, if everybody would want liquidity at the same time, it's restricted and limited. And therefore, it's semi-liquid. It's liquid for individuals. It's not liquid for panic.
So, but basically what you say is that over the last, let's say, 5-6 years, it has been more common that the retail investors actually can access the market. The fund format now is available. You talk about the semi-liquid funds, means that it's basically a fund format that is suitable and perhaps targeted towards the retail investors as well. So they basically can access this market that historically has been only for institutional investors.
Correct. And some institutional investors who have not had as much experience with the closed-end funds, they also prefer this new format and also invest in the same funds. So it's not necessarily funds that are only for the retail, but it's a more comfortable, convenient format opened up to the retail and wealth sector, but also used by the institutional investors.
And this increased interest for the private market assets from a retail investor perspective, why do you think this is happening now? Let's say the demand is increasing.
First of all, the private investors were excluded from the market, basically, or the individual investors, and saw that the market has outperformed, right? And so basically there's a logic that you should be part of that as well. And that's coming from the wealth management into the retail. Right, so wealth was first, family offices did it for a long time, wealth management is next, retail is next. And so it's opening up for everybody. And the technologicalization that allows smaller tickets and the new regulations allow for that.
So what investment horizon should one consider when entering into a semi-liquid private equity fund?
Investors should have a longer term horizon on that. And the philosophy behind that is that if you have a portfolio of whatever asset classes and a decent portion of equity in there, part of that equity you will probably always hold, and therefore you can also afford some less liquidity in there. And that would be suitable for a private equity allocation. And so for that, we recommend that you should really have a 5-year horizon, at least in your mind. That means park the money and don't look at it every day. You don't need to look at it every day. It will develop in the long run as equity does, with hopefully the outperformance premium coming through, and that will then benefit you over the long run.
And the last question then, how big portion of your portfolio is typically allocated to private markets?
That differs by individual. Family offices are very high. Pension funds are regulated to have 15%, but then basically, and individuals, they should really think of their equity allocation and their core equity allocation, of which they can put a meaningful part into private equity.
But it sounds like a couple of percentage points to up to 10% or something. Okay, thanks a lot, Rainer, for joining us, and thank you for watching us today.
Thank you.